I'm going to spend the next 20 minutes or so talking about doing business in the UK. So looking at the UK as a location to actually undertake trading activities, but also the UK as a holding company location. I just wanted to pick up on a couple of points that Nathan made towards the end of his presentation on Canada, which are very relevant to the UK as well. I don't go into a lot of detail in the slides, but we are seeing increasing compliance obligations arising from the OECD BEPS project, country by country reporting, and also changes to the transfer pricing rules. And what that means is that although the UK or indeed any other European jurisdiction might look attractive from a tax perspective, unless you're actually doing business there, it probably doesn't work anymore. And so if you're looking at putting all of your IP into the UK or the Netherlands or Luxembourg, but actually having all of your staff who do the R&D in relation to that IP in another location, then the tax regimes just don't work in that way anymore. And so a lot of what we see in the UK and indeed elsewhere in Europe is that you need to think about where the business is really going to be done, and that then drives your structure, because the transfer pricing rules will tell you that that's where the profits are recognised. And so although the two do go hand in glove slightly, we can't really do tax structuring anymore completely divorced from where business is being undertaken. And so a lot of what I'm going to talk about assumes that your Canadian business is actually going to be doing business in the UK, or can be structured in such a way that activities are undertaken in the UK. So from a tax perspective, the UK is quite an attractive jurisdiction. We had a few bumps in the road with Brexit, and in the few months after the Brexit vote, which is our slightly odd decision to leave the European Union, we did see some pullback in terms of inward investment. So people weren't entirely sure whether the UK was the right place to do business in Europe anymore. They weren't sure whether the UK was the right place to hold their European subsidiaries anymore. But actually that's calmed down. We've got until next year to figure out how it's all going to work. But in the meantime, life goes on, and we are still seeing inward investment into the UK. We are still seeing the UK being used as a holding company jurisdiction. And the main reason is because the UK is a good place to do business. We have a tax regime that backs that up. So our corporation tax rate compares very favourably to Canada. It's a 19% tax rate at the moment. We don't have separate state or local taxation, so 19% is it. That's due to reduce to 17%. And for businesses that hold qualifying patents, the tax rate actually drops down to 10%. And so it is a very good tax rate, and I'll show a comparison with other European tax rates in a few slides. We also have a very good holding company location, and Jim alluded to this when he was talking about territorial taxation. So we don't generally charge tax on dividends received. We don't generally charge tax on disposals of shareholdings in trading subsidiaries. And the UK doesn't withhold tax on outbound dividends regardless of the jurisdiction where the shareholder is located. And so as a holding company location, the UK is effectively tax-free. So we've got a very favourable regime for trading companies, a very favourable regime for the holding companies. Notwithstanding that, the first question which we frequently get asked by an inbound investor is, do I even have a tax footprint in the UK at all? And even though we've got a low tax rate, we do have other compliance obligations, whether it's filing tax returns, filing accounts. And so for companies coming into the UK, we tend to have a discussion with them about whether they do actually have a taxable presence in the UK. So we follow the OECD definition of permanent establishment, which is broadly, if there's a fixed place of business in the UK, then there's going to be a tax filing requirement of some kind. Quite often for businesses coming into the UK for the first time, they don't necessarily want an office, they don't necessarily even have a serviced office. They will perhaps have somebody working from home. They might send people to the UK for a few weeks at a time just to go and visit customers or potential customers. And those tend to be the situations where there is no permanent establishment and so therefore no filing requirement. But the successful businesses obviously quickly evolve into needing some kind of physical presence in the UK, and that would then trigger a filing requirement of some kind. Even before you get there for corporate income taxes, like all other European jurisdictions, we are within the VAT regime, and so sales into the UK and sales into the rest of Europe can be subject to VAT even without having a fixed place of business in the UK. And similarly, if an overseas company has employees in the UK, even without a fixed place of business, there will probably be some kind of employment taxes. So even without that physical presence and therefore no corporate income tax filing requirement, there can still be other taxes to think about when you come into the UK. Whether UK is really valuable for a non-European company is acting as a gateway into Europe, whether that is as a trading entity or as a holding entity of some kind. And I said that the UK tax rates are relatively low, and compared here to some of the other European rates. So a lot of the main trading jurisdictions in Europe, France, Germany, Italy, Spain, they have rates around about 30%. And so there's a very significant saving in comparison to the UK rate. And so the structure that we quite often see, I've illustrated a Canadian holding company here for obvious reasons, set up a UK subsidiary company, and that UK subsidiary company will undertake all of the European sales activity. And provided there is no fixed place in any of those other European jurisdictions, the tax rate paid on those European sales will be the UK tax rate, which will be the 19%, the 17%, or even the 10% if qualifying patents are held. And then to get those profits back up into Canada, there is no withholding tax. We don't even have to look at a double tax treaty. There simply is no withholding tax on a dividend coming out of a UK company. And so the UK can be a very useful place to operate within Europe. But coming back to what I said at the start, if you have this structure but all of your staff are sat in Germany, it's not going to work, because the Germans are going to want to tax those profits. They're going to want to recognise a German permanent establishment. And so we can't just set up the structure and say, well, everything's taxable in the UK. There needs to be some thought about where staff are going to be located. Now, clearly for a Canadian business expanding into Europe, we have the obvious benefit of common language and common culture as well. So often the two do join together. UK also gateway into Europe in terms of being a holding jurisdiction. And this is where Brexit does provide a slight bit of uncertainty. One of the reasons why the UK works as a European holding company is not just because dividends can be taken out of European subsidiaries tax-free, but also without any withholding taxes. And the reason for that is the EU Parent Subsidiary Directive. It's still not entirely clear what will happen next year, whether there will be continued 0% withholding taxes from European subsidiaries into a UK parent company. And this is why we are seeing some uncertainty about whether the UK is going to be a European holding company location going forwards. It's one of those things that we just don't know. If we do go down the route of the UK being the trading company within Europe, one of the discussions which we need to have with clients is how are you going to structure the transactions between your ultimate holding company, which may be the manufacturer of goods or it may be the provider of services, and the UK subsidiary. And we have transfer pricing rules, which typically bite on slightly larger businesses. For SMEs, it's a bit lighter touch in the UK, but we still need to have some regard to how are the transactions going to work between the companies. And the two models that we generally see would be the UK acting as a service provider. So if the UK is undertaking marketing activities and the Canadian company is the one that ultimately provides the goods or the services, then the UK company would be remunerated on a cost-plus basis by the Canadian parent. If, on the other hand, the UK company is acting as principal and providing the goods or services in the UK, then there has to be some kind of sale between Canada and the UK. We follow the OECD model for transfer pricing purposes, and typically you would look at some kind of comparable price. So if the Canadian company is selling to another distributor, which is a third party, charge the same price to the UK subsidiary, put some appropriate documentation in place, and that's normally where we end up with these relatively straightforward structures. We don't like to overcomplicate transfer pricing if we can help it, because a lot of these structures are overseas businesses coming into the UK for the first time. The last thing they want to hear is, it's going to cost you £20,000 to even come up with a transfer pricing policy, when actually to get up and running for the first few years, having something which is tried and tested is actually quite straightforward. I also want to talk about some of the incentives that are available in the UK, in particular the R&D tax incentives. So whilst we've got the low tax rates, for certain sorts of businesses, the UK tax rate can get down even lower. So we have two research and development tax credit regimes, which are not dissimilar in some ways to the way that the Canadian R&D credits work. And in fact, we come across Canadian R&D advisors advising our UK clients because the regimes are so similar, and the definition of qualifying R&D is pretty much exactly the same. And so if you're working with a company in Canada that is doing R&D and they want to do a similar activity in the UK, it's probably going to qualify as R&D in the UK as well, because the definitions are so similar. We've got two different regimes, one for SMEs, one for larger companies. Larger companies, broadly those with more than 500 employees worldwide. There are turnover and asset tests as well. But both deliver a fairly similar benefit. So for a profitable SME, it's an enhanced deduction which reduces the corporation tax liability. For a loss-making SME and for a larger company under the research and development expenditure credit rules, it offers a payable tax credit. And so it doesn't necessarily reduce the tax liability, but it gives a repayment in cash. And that obviously reduces the effective tax rate quite considerably. I've sort of been through some of the conditions there, but given the similarity to the Canadian system, as I say, the qualifying conditions are pretty similar as to what is R&D, and the qualifying expenditure is also pretty similar in terms of what the enhanced deduction is available on. And so if you're familiar with the Canadian system, you've got a pretty good handle on the UK system. There are two ways that we see the UK R&D credit utilised cross-border, and there are some hurdles to get over under both of these, but they are not insurmountable. And getting the transfer pricing working correctly from the outset, getting the intercompany transaction working correctly, allows access to the R&D credit in a cross-border situation. So it's under the first model here. You would have your Canadian company, which would still be acting as the principal in the sale of the goods or the services, but it effectively engages the UK company to undertake R&D. The UK company in this situation can still claim a tax credit. It can claim the RDEC, the large company tax credit, without much problem at all. But it can also access that slightly more valuable SME credit, provided it's not treated as a subcontractor. And that's one of the bigger hurdles and the bigger areas of focus from HMRC on these cross-border R&D arrangements, in that if you've got somebody in Canada briefing somebody in the UK on what to do, that's subcontracted R&D. That only qualifies for the large company credit. If the UK is more self-sufficient, it's got the senior R&D staff, it undertakes the R&D effectively for its own benefit, which is then sold on to the parent company, then it qualifies for that slightly more valuable SME credit. But there's no obligation under either of those two models for the IP to be owned in the UK. The IP can still be owned offshore in Canada. So if you have an R&D team sat in the UK, then we can get a cross-border R&D credit in this way. The other way round is to essentially put the principal activity into the UK, put the IP ownership into the UK as well. It removes that slight uncertainty about whether the UK is acting as a subcontractor, but it also allows potentially the UK company to access that 10% corporation tax rate. If the UK company actually has a qualifying patent, it gets the 10% tax rate on sales of goods and services. It can also claim the R&D tax credit, and that would be potentially a payable credit. And so the effective tax rate on R&D done in the UK can be incredibly low. And again, it works in a cross-border context. We have some fairly generous tax depreciation allowances, so capital allowances, often giving 100% write-off up to £200,000 a year. in addition to 100% write-off for R&D, capital expenditure, 100% write-off for energy saving or water saving equipment, so anything that's broadly green kit. We used to have 100% business renovation allowance, which was a bit too generous, and that's not been renewed. But otherwise, we've got statutory rates of 18% or 8%. And again, this all impacts on the effective tax rate in the UK business. The final thing to pick up on, where we as a firm see a lot of inward investment into the UK, is around creative sector. And I think it's very similar to Canada, where there is a very generous film tax credit, which drives business into the UK or into Canada, as the case may be. We also have tax credits for television programs, for visual effects. Video games tax credit is incredibly valuable in the UK, and we have a lot of US-based clients who outsource all of their video games production into the UK simply to access the credit, but then they pull the benefit of that back into the US under the contractual arrangement. And so they're effectively moving that credit back into the US under the contractual arrangement. We have animation tax credit, we have theatre tax credits, we have orchestra tax credits. So a lot of creative sector reliefs that are designed to not only support domestic creative activity, but also to attract that activity into the UK. And very valuable, work in a very similar way to the R&D credit with that enhanced relief. So if anybody's got clients in these sectors, the UK is certainly worth looking at. Hopefully I've kept to my 20 minutes, even if I don't manage 2 minutes there, Brian, which was Brian's initial suggestion. But are there any questions? So you're talking about group relief for losses? Yeah. So yes, we do have a group relief in the UK, which has actually become more generous as of last year. So now both current year and brought forward losses can be used by other group companies, and there is no limit, there's no time limit on carry forward. Until April 2017, there was a limit in that only current year losses could be claimed by other group companies. And so there's a bit more flexibility now. You don't have to restructure to move your losses around. The idea being that although we don't really have the concept of a fiscal unity, you effectively get that benefit with the offset of brought forward losses. The what, sorry? It is getting better, yeah. Any other questions? Yeah. That sounds like a very loaded question. Yes, so discussions that we've had with clients, particularly those who need regulatory approvals to sell into Europe, is whereabouts are they going to move activity to, or if they're coming into Europe for the first time, whereabouts do they want to set up? Sometimes that's driven by where there is the available workforce and capability to actually do the business, and if that's in the UK, then that's in the UK. But for financial services businesses, for other regulated activities, there has to be a backup plan. And so we're seeing a lot of clients who are looking at setting up parallel structures elsewhere in Europe. It might be in the Netherlands, for example, if they're importing goods and they need a good infrastructure to do that. It might be in Ireland if it's financial services and they want to have a similar level of expertise, a similar regulatory regime to the UK, but still be able to passport into Europe. And so at the moment, it's almost a backup plan, but they've got to get up and running in readiness for that. So resident non-domiciled individuals in the UK have historically had a very beneficial tax regime applying to them, in that they're only taxed on UK source income. That principle still remains. What changed last year was that anybody who has been in the UK for more than 15 years can't benefit from that regime anymore. And so we have a lot of clients who've been in the UK for 30, 40 years still not domiciled and still taking advantage of the old regime, they can't do that anymore. But there's a whole new wave of people coming to the UK, and so we still have a lot of clients who are well less than the 15 years. They still benefit from that. A lot of private equity executives, for example, coming to the UK, they will benefit from that favourable regime. What we're finding as they get close to their 15 years, we can undertake some structuring for them. We can move them into protected trust structures. So non-DOMs can still benefit from a favourable offshore trust regime. But we are now seeing, given the regime's not as good as it used to be, people are leaving the UK. And they are looking around at other European jurisdictions for somewhere that will offer a similar regime. They need to go out for 5 years in order to reset their clock, and then they'll come back to the UK. Not for individuals, no. So although we have exit charges for companies, we don't have an individual expatriation regime, and so people can leave the UK without triggering any capital gain. So it's very easy in some ways. Somebody decides, I don't want to be resident in the UK anymore. They just leave the UK. They spend fewer than whatever the day count necessary